Welcome to Prescient Investment Management's Q3 2025 webinar on equities and multi-asset. I'm Joanne Baynham from Asset TV, and today I'm joined by Bastian, Chief Investment Officer, Seeiso, Head of Equities, and Shriya, Portfolio Manager of Multi-Asset. Welcome to you guys. I'm really looking forward to today's chat. Lots happening in the markets. Bastian, I'm going to kick off with you. You've been quite vocal lately talking about how the US doesn't have an inflation problem, it has a growth problem, and everything you guys do is systematic. What in the data is telling us this?
That's a good point, Joe. Thanks. And yeah, thanks everyone for joining. So I guess if we look at markets and what they've done this year, a lot of positives. Where does this come from? And we think it's more coming from the fact that inflation has surprised on the downside, which hasn't surprised us that much, because we always said that the introduction of tariffs is not going to be an issue. It's not going to be an issue from an inflation point of view. It will actually slow inflation, not drive inflation. And that's exactly what's coming through. It's also why there's the door wide open now for interest rate cuts, and all of that has helped markets. But I guess where the downside surprise potentially has come this year, and it's something which we've said for the year, that there's a slowdown coming, and the data is showing that, and we have said that for a while now. We've been very positive on US growth post-COVID. So for the last 4 or 5 years, we've constantly preached upside surprises in the data on the US economy, and that has come through. But as we look at it right now, it looks like there's more downside surprises. So we see that most pronounced in the unemployment rate starting to creep up. We're worried about non-farm payrolls coming down. So basically all broad-based labor market metrics, but then also consumption data, all of that is hinting to a slowdown.
Isn't the consumption data one very tricky at the moment, given the top end of the market seems to do a lot of spending, and they look like in rude health, and then the bottom part of the market that doesn't do as much spending? Maybe give us some more detail around that?
Of course, it's always important to break it down into that detail, and we do that. The reality is that we can track spending or consumption quite broad-based, so the extent to which spending is driving the economy, we pick that up through consumption expenditure in general, and we can show that that has started to slow down, and that shouldn't be a surprise. It's a slowdown because the labor market is getting weaker. So if workers have less confidence, then eventually they will spend less, and that's just the result of the confidence crisis, which was kicked off earlier through the Trump administration with a very volatile trade policy setting. Okay, so if we look into the US economy, we always like to break it down into these 10 buckets. And what I just mentioned was to talk about the consumption expenditure, which is basically this part, and then also the labor market, which we could obviously open up much further. But jumping past the actual growth narrative in total, the reason why it's so important to understand the details is because you really want to understand where the slowdown is coming from. So if we just look at that chart, we once again have those 9 buckets which drive either the economy to slow or the economy to grow quicker. So everything above the line here is driving the economy to grow quicker. Everything below the line is driving the economy to grow slower. And what we're most interested in is this very last line on the right-hand side here, that bar. We're going to flip that on the side and look at it a little bit more detailed. And now you can see exactly what's detracting to the left-hand side of the zero line. So what are those detractors? And the key areas are exactly the one Joanne already mentioned, personal consumption expenditure. So that's detracting quite a bit. And the other one is the labor market. And those two detracting, that goes hand in hand, right? Because if you have a weaker labor market, you will also have weaker consumption expenditure. Okay, so let's look into that labor market component a little bit more detailed. The labor market component is actually even more pronounced than the personal consumption expenditure component. And if we break that one up ever further, you can see that the key culprits are the ones I mentioned in the intro. It's basically non-farm payrolls, the current level of non-farm payrolls, even particularly the short-term non-farm payrolls, showing quite weak trends. It's over here, the broad-based Fed labor market conditions indicator. That one is basically summarizing everything you see in front of you. And then at the bottom, if we look into the unemployment rate, you will see that we look into something which we call flexi slope. That means that we're looking at the rate of change. So you can see that there's a negative rate of change, i.e. the unemployment rate is climbing up, and that's the third reason to be worried. So to bring it all together, lots of reasons to not panic, but be slightly more pessimistic about the US economy.
Basti, one of the things you mentioned, which I think a lot of people are grappling with, is that tariffs aren't inflationary. You claim they're deflationary. Maybe just give us some more color.
Yeah, that's a good point, and I'm going to illustrate that as an example. By the way, before I start, I found it interesting that most people are grappling with that, because the reality is that the empirical evidence is quite clear. Whenever tariffs got introduced in the history, that led to deflation, not to inflation. So it actually shouldn't come that much of a surprise. But here's the reason. So the reason is a basic economic one. If you have a car and you slap a 20% tariff on it, obviously not the full 20% get passed through to the consumer, but for the sake of simplicity, let's assume it does. Okay, so then what happens to the car price? The car is 20% more expensive. So that's in year one. What happens to the car price in year two? Okay, it doesn't get more expensive at all. It stays exactly at that level, because even with that 20% tariff, the car is now 20% more expensive, but inflation is a rate of change from a year-on-year point of view. So with that, now the car stays at that level. It does not get more expensive. But what happens to the consumer? What happens to the economy? So the economy will, or the consumer will now say, well, the car is so much more expensive, I'll buy less cars. I'll substitute for a smaller car. I'll take public transport. So all of these substitutions are actually not just deflationary, but also hampering growth. So by no means are we saying that the tariffs have no impact on the real economy. They certainly have. But the reality is they're not driving inflation. They are more deflationary. And that gets ever more important if you look into the impact on growth. Because we always like to say it's a once-off price shock, but it's a lasting tax on the consumer. So consumption gets slowed and the prices are shot up once.
Okay, so not inflationary, arguably deflationary, but a hit to growth. Okay, so say you're right, okay? What should the Fed be doing about this? And I believe you have your own AI models. Maybe you want to tell us more about it. That's looked at the recent Fed minutes, commentaries they've written. And what are you establishing from reading all that stuff? Well, the computers are reading it, but your take on it.
Yeah, we're reading what the computers are preparing for us.
Exactly.
But the reality is that if everything I just said comes true, right, then you should ask yourself the question, why has the Fed not started to cut rates yet? So it's no problem around inflation. The tariffs are not going to be a problem either. And there's actually a problem with global growth because it gets slowed down by those tariffs and the negative impact on global trade. So with that, why no interest rate cuts? And we ask ourselves the same question. So what we did then is we introduced a natural language processing algorithm, which looks into the detail of what the Federal Reserve is talking about. And what we pick up there is quite interesting. Okay, so that natural language processing algorithm, which I was just speaking about, you can see that on this chart. So it looks pretty basic. The red line is just the Fed effective fund rate, so nothing else other than the interest rates defined by the Federal Reserve. And the blue line is our assessment of whether the chat of the Federal Reserve, or basically the protocols of their committees, the FOMC, which they release, whether they are dovish or hawkish. Okay, so just to explain that in a little bit more detail, after every Fed's meeting, everything they said gets compiled in a PDF and uploaded on the website. What we do is we automatically jump on the website of the Federal Reserve, and we will then download those PDFs and classify the tone of those speeches as either hawkish, dovish, or neutral. Okay, so if we do that through time, and you can see a summary of those relevant speeches in those little boxes, although that's not that necessary for this analysis, but you can see when interest rates are close to zero, so at the bottom of the chart, you can see that our classification is always dovish, 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 right? So the model kind of works, and that's quite remarkable given that we don't really tell the model what to look out for. We just ask the question, is this hawkish or dovish? Okay, when we then eventually move closer to 2015, you can see that it gets more jittery. There's also speeches now starting to be classified as neutral or hawkish until we really hit the hiking cycle, and then there's a lot of speeches classified as hawkish. We can do the same analysis for 2019 until 2021. Same story, interest rates close to zero, speeches very, very dovish, and then eventually we hit Jan 2022, and we see the first very hawkish speech, and it's just shortly after, actually 2 months after that, that we see the first hike in interest rates. And then we stay hawkish for a while. So basically our analysis of the words which come literally out of the mouths of the governors of the Federal Reserve, they tell us pretty much exactly what they're going to do. And we obviously see that as a big part of information advantage. And if I just link that into our story, which we just had, we know inflation is not going to be a problem. We know growth is slowing. So why have they not cut? And the interesting bit is if we start this year and just look all the way until the later part of this year, until today basically, most speeches had been classified as neutral. And if we look into the little boxes which you can come up there, which is summarizing the speeches, the talk is often about a split committee balancing off the risks on the upside to the risks of the downside. And at the same point in time, they also speak a lot about wanting to wait and sit and wait, and the fact that they can't impact trade policies. So we've seen a Fed which is on hold, maybe for political reasons, we don't know that, maybe because of reasons of uncertainty around trade policies, but the reality is they haven't reacted. And it's only after this very last cut, which I'm bringing up here, which is September the 17th, where they've initiated the next level of the cutting cycle. And our worry is that this is just too late, and that this data suggests the natural language processing, which basically takes the sentiment of the speeches, it suggests that the committee has been indecisive and on the waiting line for potentially too long.
Okay, that's very interesting. But is it your opinion, after looking at these large language models, that the Fed's been a bit slow to cut and therefore the growth outlook has actually worsened? Because had they been a bit quicker, your worries about growth wouldn't have been quite as bad. Is that kind of what you're saying, to sum it up?
That is pretty much exactly what we're saying, and we must just be aware of the fact that monetary policy impacts the real economy with a massive lag. So we're talking about 12 to 18 months. We've been tracking this slowdown now roughly for 12 to 18 months, right? So if you now start to cut, which has actually started in September to bring rates down, and now you wait for 12 or 18 months to see the impact, while the economy is already on the brink of a recession. I mean, the labor market looks very shaky. Inflation is not a problem at all. So yeah, you're too late. So that's a risk. I'm not saying that now we have to hit a hard recession, and also not saying that this is going to be massively negative for capital markets. But should they have cut earlier? Certainly they should.
Okay, and to sum it up, that's bond bullish.
It would be bond bullish because they haven't cut, and now they need to cut. We look at way more factors. And I mean, this is more the multi-asset and equity webinar, but for the bond story, this is one of the positives. There's other negatives as well, but yes, 100% this would be positive for bonds, and especially for US bonds. Less inflation, worries around growth, accelerating the need for haven assets. That's very bullish for US bonds, and that's where we are bullish.
Okay, I'm going to get Shriya to give us more detail around that. Shriya, you've just heard the background to how Prescient as a house is thinking about the world, but let's go back a step. What's happened the last quarter? What worked? What didn't in the multi-asset portfolios you run?
Thanks, Jo. So over the last quarter, we've focused more on de-risking. So if we look at where we sat at the end of the last quarter, at the end of June, we already started de-risking. And where we are now, it's not extremely different. Our views just have more conviction. So I'll show you that in the positioning. But essentially, over the last quarter, we've taken exposure off our local equity building blocks, our global equity building blocks, so that's developed market equities as well as emerging market equities, as well as SA bonds and SA property. And we've now tilted more towards SA income and global income. So SA income at the front end of the curve is giving us really, really attractive yields and at a reduced risk profile as well. So now where we're sitting, if we look at geographically as well, we're sitting a little bit more in SA than we usually would from a strategic point of view. So strategically, we have 45% offshore. Now we have 40% offshore. So 60% more or less is sitting in South Africa. Has it worked for us? Has it not worked for us? I know you like that question, so I have to be honest here. I'll definitely say that we know that it's been an incredible year for equities. I mean, your SA equities, the all shares over 38% now year to date. That's insane. And we've been underweight our SA equity building block, for example. Now, is that a good call? Is that a bad call? For us, it's all based on probabilities. So we look at what's the probability of this asset class underperforming versus it outperforming. And for us, the risk was to the downside, and hence that's why we've taken exposure off. Would we change that? We won't, we can't, because it's not our process. And our views are also forward-looking. So over the next year, that's kind of what the view is.
Okay, so you've pretty much taken risk off across asset classes. You've increased your income both offshore and locally. But let's get back to within asset classes, so equities versus bonds. Which do you think has the better opportunity set, local equities or local bonds? And I'm going to ask you another question once I hear your answer.
Okay, it's an interesting question because we're actually quite cautious on both at the moment. So I think let's show you our asset class views and we can go into more detail. Taking a look at our asset class views, as I mentioned before, we are quite cautiously positioned. So you can see lots of neutral and moderately negative on the screen. Now, Joe, coming back to your question on equities and bonds, we are both negative on equities and bonds, as you can see here. But what drives these decisions? How do we get to this? Well, let's look at bonds, for example. I can extend that, and you can see that we've got a view on every part of the bond curve. We are a little bit more bearish on the back end versus the front end. And if we go into the SA 10-year, for example, you can see that we look at various lenses. Okay, so we look at how the assets price, we look at valuations, we look at the economic environment, we look at financial conditions globally, and we look at sentiment. We go one level deeper, and I can show you how do we actually get to these top level views. So let's look at economics and tie it into what Basti said. Basti mentioned the fact that US growth is slowing, and that's exactly what we're picking up here. That's important when looking at SA bonds. So you can see the slowdown in the labor markets being reflected in a slowdown in non-farm payrolls. So that just adds a little bit more color on how we get to this view.
Shriya, you're not off the hook yet. Okay, so local equities, local bonds, and different, bearish to both. In this scenario that Bastian's painting of a US slowdown, traditionally when that happens and bonds do well, the dollar tends to do better because the other emerging market currencies sell off, okay? And at the same time, they sell off because they're expecting huge interest rate cuts from America, and the gold market continue to rally. Now, as we know, South African equities this year have been a gold story to a large extent. Taking Bastian's view that we have a slowdown, which will lead to lots more QE, does that concern you at all when you're looking at local bonds versus local equities? Because local equities could rally because of gold shares.
It doesn't concern us. I think what we think is that we'll always be able to change, we'll always be able to adapt depending on what the current market environment is. So we can obviously look at different scenarios, the Fed cuts or they don't cut, or if, emerging market currencies start to tank and the dollar starts to strengthen again, we'll be able to take all of that information and put it into our tactical asset allocation models. That's what it does. And every day we'll have a view on asset classes around the world. So I know that's more.
No, it's a great answer. It's a great answer. You're fluid. You're fluid. At the moment, you're indifferent between the two, and you're bearish on both.
Yeah.
But it's a fluid situation, and you will tactically change if the facts change.
Yeah.
Which I think is fantastic.
Story.
Well done. Okay, Seeiso, let's talk to you now. It's been a fantastic year and probably quarter for the JSE.
Stunning.
I mean, it always happens when everyone says, don't buy local shares, go offshore. I think it does it to irritate the industry.
Yeah.
So what happened the last quarter, and where did you see what went well?
Yeah, well, it started off actually quite shaky, but you're quite right. It's been a phenomenal quarter for global equities broadly, just the equities asset class. And if you take a look into it, it's mainly been driven in the MSCI developed market world space by the tech theme, and we saw corporate earnings for the second quarter of the year come through quite strongly. And moreover, we've seen this rate cut boosting sentiment for investors, and also pricing in expectations for further rate cuts. So phenomenal from that perspective. But emerging markets, funny enough, trumped developed markets.
You were dying to say that, weren't you?
Yeah, yeah, because we've been favoring emerging markets over developed markets for a while, yeah, obviously the big heavyweights like China and your Taiwan's also feeding off the AI theme. But even locally, you look at our local South African market, which is in the emerging market cluster, contributing quite strongly to that emerging market performance. So I think the JSE All Share over the third quarter was up something like 13-14% in ZAR, which in dollars, given the weakening dollar and the strengthening rand, moves up to something like 16-17% in dollars. So all in all, very strong from a beta perspective.
And listening to that kind of performance, I can see why you guys are feeling a little bit bearish, because when you've had that kind of rally, a pullback is probably ensuing. Are there any styles that stood out for you, like value versus growth, momentum, quality, anything that you said, wow, that's quite interesting?
Yeah, so I mean, obviously the momentum trade carried through, but more than styles, I think what we picked up on is obviously the themes that I've mentioned, but also specific sectors that have really carried through the markets to find, you know, record highs. You mentioned earlier gold and PGMs locally have obviously been phenomenal, with the gold price I think rallying something like, I don't know what it is, something like 16-17%. It obviously pushes up all the gold miners, and then once that goes up, it filters into your PGMs, the platinum miners as well, with platinum also rising. So from that perspective, it's been it's been driven by specific sectors, and if we're looking at it from a factor perspective, it's obviously been more the momentum that's coming through, as opposed to if you look at traditional valuations, because valuations are a little bit stretched at the moment. There's no two ways about it.
Okay, especially I assume on AI.
Especially on AI, but we often argue, and I think that's one of the benefits of being a systematic house, is that we take multiple lenses. Shriya showed that we don't just consider valuation as the sole informer of our view. There are other factors at play, macroeconomics, investor sentiment, etc. And I would further go on to argue that perhaps when you're looking at a relatively new sector like AI, the old way of looking at even valuations is not, strictly speaking, still relevant. So a PE ratio for a tech company is not necessarily does not have the same explanatory power for potential future growth as a PE for a mine. But that's just my argument.
So it's different this time.
Yeah, that hasn't been said before, has it?
No, I'm teasing you. Okay, Shriya, let's talk about geographical analysis. So you kind of alluded to it just now. You've brought your offshore back. But Bastian's also been quite prolific in the past by saying you don't have to bring the offshore back, you can just hedge. So tell us what you're doing.
Sure. So I'll start off by saying that, I said this at the beginning, but just to reiterate, strategically we like offshore. So we have our portfolio, our balance fund has 45% of the portfolio sitting offshore. But the important thing to consider when making an offshore investment is the currency, because you have this amazing opportunity set and that can give you great returns, but you're a South African investor. So you get the return of the thing that you're investing in, be it Apple, for example, or Tesla, whatever you like, but then you're also getting the return of the currency. So if the rand strengthens over the short term and you bring that dollar return back to rands, you're losing out. We know over the long term that the rand will depreciate, but over the short term, I mean, we know the rand, we never know what's going to happen, right? So that's why we have a little bit of a hedge in, and that really helps us to get more of what we need offshore. The other thing is that in South Africa, it's very concentrated. I mean, I'm not saying that it's a bad place to be.
Relatively.
But in a balanced fund context,
Yeah.
Diversification is key. It's key. It's the bedrock of multi-asset investing. So it's not that we don't like SA equities. We do. So we've got 25% in that strategically. Now it's a little bit less. Remember, even though we're negative, it's a little bit less. We're not taking it all down to zero. So it's sitting at around 23% at the moment. Offshore, your opportunity sets in your developed market equities, in your emerging market equities, you have access to almost 2,500 names, just over that. And that for us is just incredible. So that's why we do prefer diversifying as much as possible, especially in scenarios that we've seen this year. And yeah, we'll continue to do so, but also be fluid enough to tilt around when need be.
Yeah.
Okay, maybe I'm being very stupid here. So are you saying you still have a very strategic allocation to offshore, you're just hedging out portion of it via dollar rand swaps or whatever? So it's not like you're not physically bringing the money back, you're just hedging out the currency risk.
Yeah.
Is that what you're doing?
Yes, exactly. It's purely on a currency basis. We still are targeting that CPI +6, but we're doing it at a lower risk allocation.
And can I take it from that you think the rand will be strong?
Well, currently we've got a moderately negative view on the rand, which means that we don't think that it can strengthen any more than it has.
But you're hedging it out.
We are, but so we have 17% of it strategically. We've now brought that down. So our rand play goes into how much we hedge. We've hedged,
right.
yeah,
Okay.
so we've brought that hedge down a bit.
Great. Seeiso,
Yes.
you're a systematic house. I think you've mentioned that before. You're not passive, you're not quants, you're systematic.
Once or twice, I think I might have mentioned that.
How has that helped you navigate the last quarter through the volatility we've seen?
Yeah, so I think the not just the last quarter, the last year to date, I think there's been plenty of examples where being systematic and being objective and being data driven has arguably helped avoid potential pitfalls. And really recently tried to get awareness around the pitfalls around behavioral biases, and particularly in a volatile market, and how those could potentially influence investment decisions. So, Basti always accuses me of this loss aversion, and I'll admit I am a little bit loss averse, but it's a very well documented bias. It's hardwired into our brains to, hold on to the gains and avoid losing. So if, for instance, you're not a systematic manager, and you have this bias, you would have been clearly, you would have been quick to cut your losses when the markets were running, or you would have taken off your profits too soon, because you're protecting what you've already gained, and therefore missing out on potential gains. So all this to say, a systematic process really does help you remove a lot of those biases, stay objective in volatile markets, and that gives you an additional edge.
Talking about edges, you have the portable alpha strategy. How did that work out for the third quarter, and what are you doing inside that portfolio?
Yeah. So the portable alpha strategy has actually worked out really, really well. It's designed to naturally split out two sources of return into the beta, and it's always great when the beta runs, even though we're not responsible for that. Obviously, that decision is taken at a level up. But when the beta runs, and also you have strong alpha generation, then the portable alpha proposition really shows what it can do. And that's precisely what's happened this year. So as Shriya said, the sort of local market is up 35% year to date. That's a big absolute number. And then on top of that, from an alpha perspective, our alpha engine has managed to add, call it 2.5% on top of that. So it's done phenomenally well. And there's again, a systematic process behind that, and sort of predictable reasons why we've managed to achieve that result.
Just in case anyone doesn't know you guys, do you just quickly remind us what that process is in as few words as you can?
Yes, in as few words as possible.
What is portable alpha?
Yes, so
it's not active stock picking, right?
No, it's anything but
right,
active stock
okay.
picking. So it's basically unfunded passive beta exposure with a alpha engine on the back of it. And for our purposes, our alpha engine is the cash and income space, a structurally better place to go looking for alpha, and an asset class that we know well and we like very much. So that's where we generate our alpha. I think Shriya mentioned that's the area right now that a lot of money is flowing into, because it's ostensibly more safer. It's a safer asset class to be in. So that's where we go hunting for alpha. That's where we're super active in our allocations. And right now we are similar across the floor. We've positioned quite conservatively in our alpha position, but still generating a healthy amount of alpha. So it's cash alpha, little words as possible, cash alpha with equity market beta.
I just want to jump in here quickly, very quickly. One thing that's great about the portable alpha strategy from a multi-asset point of view is that our building blocks are not passive in nature. they're active. So when we talk about our SA equity allocation, we're not just taking exposure to the top 40 or the all share, we are allocating towards Seiso's fund, which means that we're getting the market plus we're getting this enhanced alpha on top of that, which we get for free.
For free. They're precisely designed as building block funds that fit into a multi-asset portfolio equity allocation. Obviously Shriya and the multi-asset team are one of our bigger clients, they were designed to be that anchor for an equity allocation for a multi-asset building block.
So anyone listening to this, it's passive plus using credit, right? Okay.
I mean, you redefine using yes. as little words as possible.
Yes. Okay, Seeiso, thank you so much. Back to you, Shriya. Cash, you clearly like cash, but cash offshore, cash locally, short end of the curve. Give us some more insight into that, please.
Sure. So I'll start off by saying that when we optimize our portfolios, we don't put income or cash in there in a CPI plus 6 mandate, because you need to take on risk to get there, right? But obviously in these shorter term scenarios, when income onshore is giving you 8%, it's a no-brainer. So what we've done, as I mentioned before, we've tilted more towards SA income. So we really like the front end of the curve. We're more bullish on that than we are on the back end of the curve, as I showed before in the views. And then offshore as well, you're getting around 4.7% in our global income fund, which we have exposure to. And that's also a great place to be. So you take that 4.7% after inflation, bring it back to South Africa, you're getting around 4.5%, which is great at a risk profile that is, steadier than what you would get in the equity market. So it's always a risk game for us. We can't be too attached to any asset class. We have to be quite unbiased, and we are. Again, that is our process. And so that's why we like income. The yields have been great.
Okay, and as your process is very systematic again, just back to Seiso's comment, it's not emotional or gut feel, it's based on what the data is showing you. Okay, so one of the things I think a lot of us struggle with in markets, Seiso, is active versus passive. It's a debate that goes on for hours. Yeah. And as you look at the world today, and given all the scenarios you're looking at, the next couple of months, is this an environment for active managers or passive managers? And if so, why? Which one?
So that's a very interesting question. And I mean, this debate has been dragging on for ages. The claim to fame for active management is always around when the market tanks, right? That's when they're meant to be the shield, because a pure passive beta play is going to just tank with the market. But the empirical evidence doesn't actually suggest that. So you'd think that during bear markets, active management comes through strongly, and it's not necessarily the case. So we don't categorize the two methods of managing money as exclusively mutual, right? We don't say if you're walking, then you have to stop chewing gum. If you're going this way, you have to stop. You're not going that way. So we always say, is it too much to ask for both? And in our process, hence we incorporate the two. But anecdotal evidence would suggest that, okay, we've had this really hard run in beta. And as you said, you look at equity risk premiums, they're mean reverting. This hard run is likely to lead into a softer equity market performance going forward, and therefore active management should come through strongly and be that shield. Our argument is, you can, whether you believe it or not, you can exploit both active and passive management within your process.
Okay, I just want to carry on with this topic though. Active management is interesting. You say it doesn't always protect you when markets are falling. We are arguably in very concentrated markets today.
Yeah.
if part of the reason for the fall is because of this ridiculous concentration, is it possible that active could do better in that environment because they are underweight the concentration?
Yes.
Or is that hoping for too much? I know you're not saying, I know you've very made clear you're not wed to either.
Yeah.
You like them both. But just a question in terms of protecting the downside.
No, definitely. I think, again, anecdotally, I would say it's definitely possible. So we saw resources now, I think, in the Aussie have shot up to over 30% of that index, which is admittedly very, very concentrated. If you think the cycle is about to turn and you are an active manager and you correctly go, call it 5% underweight that, then definitely it's possible that that could provide a level of protection in that cycle. Where we are, we would be through the cycle. We're looking at it long term, and from that perspective, we're always going to be harvesting the equity risk premium for the long term, and therefore our premise would be stay invested. Keep your beta throughout the cycle, and you will reap that benefit. But I take your point 100%. If you are an active manager and in this with this high concentration, and you manage to get it just right so that you're underweight right when it turns, you'll definitely provide that level of protection. But the thing is, they don't necessarily do that.
Can I just jump in there also to add one point? So the implicit assumption we're making always is that active managers are better diversified than passive managers, less concentrated than the index. If you look into the empirical evidence, the opposite is true. So if you break it down, and we can speak as much as we want how concentrated South African equity market is or the US equity market is, the average active South African manager is running a way more concentrated portfolio than the SA equity market. And there's different ways to capture that. We like to look at it's called the Herfindahl-Hirschman index, which is basically a measure of concentration. Do that for the larger funds in South Africa and see if they are more concentrated than the index. And the answer, they are more concentrated, not less concentrated. And the same applies in the States. So to Seiso's point, the way we run our strategies globally is we hold all the shares. So we hold almost 2,000 shares in the derived market space, more than 2,000 shares in the emerging market space. We are way more diversified than most of the active managers there. So I guess it always comes down to the starting point, and the implicit assumption must not be that the active manager is more diversified and less concentrated. The opposite is mostly the case.
Okay, I've been schooled.
Okay.
I
had one more point, but if you've been schooled, it's fine.
Now we're looking forward, Seeiso. What should I be worried about? What are you worried about? What are you seeing? What tea leaves are you reading? Tell us.
I mean, naturally, valuations have been relatively stretched at the moment, and if we're looking at it, there's two things. I'll speak about it from a beta perspective, and I'll speak about it from an alpha perspective. So, from a beta perspective, if you look at our house view at an asset class level, we are cautious. Like moderately negative sounds a bit worse than it is. We are cautious on both SA equities and US equities, and the reason for that being, well, actually two completely different reasons. On the SA side, it's more sentiment driven. Yes, valuations are a little bit higher than average, than their long-term averages, but that's not the main driving factor behind our pessimism of the market. Whereas in the offshore, in the US market, still also cautious, but more so because the traditional valuation metrics are screaming, looking quite frothy. So obviously the concern then is obviously a big correction in the markets will impact your beta, and on a at least in the short term, on a relative basis relative to our competitors, we could end up getting hurt from that perspective. But on the alpha side, we are actually quite optimistic because again, our alpha comes from the cash and the very short end interest bearing space. And in there, if you look at just basically what what we're poised for from a rate expectations perspective, we have every one bullish. We have every reason to be optimistic in the expected alpha, especially in the very short end, the very neutral, safe part of the curve. So if you go longer out, then yeah, obviously there are bond models. Again, it's not a bond webinar, but are showing that there is a potential for a correction in the yields, but in the very short end, which tends to be quite defensive, we're very optimistic.
Yeah, real rates are very high here still in South Africa. Shriya, if listening to you today, if I'm looking for a balanced solution, why should I choose your fund? Why should I choose the Prescient Balanced Fund instead of somebody else, or doing it myself?
Sure. So I think the quick answer is fees.
That's a great answer.
Which is one we all like.
Yes, okay.
But yeah, I mean, look, you're getting, in our balanced fund, you could 100%, you could take out fact sheets at the end of every month and you could try and do it yourself. But the reality is that you're not going to get to the returns that we're getting. Because as I mentioned before, our building blocks are not passive in nature. So we're investing in Seiso's portable alpha funds. On the bond side, we've also got portable alpha on that. Offshore, we've got portable alpha on our equity building blocks. So it's all enhanced indexation. And then on top of that, we're currency hedging, which it's quite involved. It's quite seamless for us now because we've spent a long time setting up the process, systematizing everything.
I don't think anyone thinks currency hedging isn't difficult. Just so we're clear, I think we believe you when you say it's difficult. Carry on.
Trying to convince you.
No, I'm completely convinced.
So there's a lot going on under the hood, and it's also the tactical views that we take every day. I mean, we've spent years building these systems, and so where we are at the end of the month, during the month, we're switching, we're dynamic, we're quite fluid, and it's quite easy for us to move in and out of asset classes because of the way that we get the exposure. So we get exposure through using derivatives, and it's very cost effective for us as well. So taking all of that into account, it's incredibly difficult for one person to do that on their own. And that's why you would go with a fund like us.
Great. All right.
And then also,
there's more.
If you are looking at a mix of balanced funds, there's also a place for us. Okay, because we know lots of people like to, build their model portfolios, and where you would find us is more as a core offering. So we want to provide our investors with that steady alpha profile through time, and then you could tilt around that. So use a more aggressive equity fund on top of us, or a more defensive fund with us if you want to go towards that. What we focus on again is getting that steady profile through time, making small amounts of alpha and letting that compound.
And did you say earlier you got a CPI plus 6 target?
Yeah.
Okay, that's a pretty heavy target. All right. Looking ahead, what are you? I mean, you've told me you're bearish local equities, bearish offshore equities. You're bullish US bonds.
Yeah.
But anything else you want to tell me about the kind of the future that you're looking into for the next quarter?
I wish I could tell you what the future would look like.
I wish I had that crystal ball. But let's pretend let's pretend you have one.
So I think we'd be cautious going into the last quarter of the year. I mean, if you're looking towards rates, there's I think just under 2 cuts priced in the US, and then looking more locally, I don't think there's one priced in for the rest of the year. It's more towards the next quarter. So we'd obviously be looking towards that. And where it affects markets is if what's not priced in plays out. So what's helpful about our process is that we're able to pick up these things. We won't do anything preemptively. So only when the data becomes available, only when we start seeing change, that's when we'll move. So I'll give you an example. If, say, equity markets crash and investors start panicking, they start to, because we look at the price that people would pay for protection on asset classes, and that informs our sentiment view. So say those two things blow out, then we would put risk on. And that's the way that we see the world. Where we would take risk off is, again, if equity markets continue to run and the market remains complacent. So again, it's looking at those 4 lenses, how it's priced, is it supported by economic growth or not, what are financial conditions doing, is the Fed gonna do some QE, will there be more money going around to stimulate the economy, and how are people feeling?
So the how are people feeling thing I think is crucially important here, and it's about you're basically saying people are complacent at the moment.
Yeah.
That's what I'm hearing.
Yeah.
They said, they're a little bit too euphoric.
Yeah.
Okay, we've talked a lot today.
Yeah.
Lots of different comments coming out, and I hope it's quite clear to anyone listening what we've shared. But Bastian, I'm going to let you sum it up for us.
Yeah, thanks, Jen, for that question. Yeah, and to sum it all up, I mean, we look at different lenses, obviously, to come to conclusion that, as Shriya and Seeiso said earlier, it's a more cautious stance, not too conservative, slightly more cautious, and the starting point is obviously valuations, especially in the global space. Valuations are quite stretched, mostly in the US equity space or global equity space. We're worried about those levels of valuation. Locally, things are certainly more attractive from a valuation point of view, but also not as cheap as they were a while ago. I mean, equities up 40%. We don't just look at how much our equities are up for the year. They can, if they're up 40%, they can go up another 40%, but what you said is actually spot on, that question on sentiment and complacency. And we measure that systematically by looking at implied volatility close to an all-time low. So market participants are not worried at all. And that, in our opinion, doesn't add up with the macroeconomic uncertainty. We've tracked those slowdowns. We've broken it down during this webinar, even where it's coming from. The one positive thing is the uplift from lower inflation prints. So it's one element where we are slightly more optimistic on it, which pushes us closer to a neutral. But overall, a more cautious stance is warranted, especially also if we look into monetary policy. Sometimes people get optimistic based on the fact that the Fed is going to cut, but the cuts are now in the price, and the timing of the cuts has not been ideal because they come too late. So with that, financial conditions remain quite tight right now. And it remains to be seen where we're going. To Seiso's point, it's about small tilts, and to Shriya's point, it's about compounding those small tilts, and that's what we keep on doing with the systematic process.
Okay, one final question from me, which you guys have not seen. Gold. How does that fit within your systematic process at the moment? Because presumably sentiment's pretty euphoric right now.
Yeah.
So do you want to just give us one sentence on what you're thinking as a systematic house on gold?
Of course, I mean, we don't look at the price of gold in isolation, but it's exactly to that story. So we measure sentiment as euphoric through all-time lows on implied volatility. That's exactly the reason why you've got asset classes like gold, if you want, Bitcoin, running basically in line with equities across the globe, right? So it's can define complacency or euphoria in different ways. Some people would just say that markets have ran quite hard, and that's the reason to be worried. We don't do that. More scientifically approached, what are people worried about? And we can measure that scientifically, and it's quite clear to see that they're not worried about a lot, and that's where the problem lies.
Not worried about a lot, and that's where the problem lies. I like that. Please stay with us. There's time for Q&A now, and I hope you guys are going to send lots of questions.
Cool. Hi, everyone. So we're going to take as many questions as we can. There's quite a few, which is awesome. Just means there's a lot of interest, which gets us excited. So just to be clear, we're just going to read the question, and then one of us will pick it up. So we start with the first one. It says, as a systematic house, how do you play thematic changes and the rates of change, if at all, strategic or tactical?
I think I'll take that one. Plays quite nicely into the multi-asset space. So strategically, when we form our strategic asset allocation, we look at the long term. And so when we would change that, it would be when anything structural changes. So I'll give you an example. If the inflation target locally now changes from 3 to 6% to 2 to 4%, which we know are in the talks, then that would be something that we would change in our strategic asset allocation. In our tactical asset allocation, that's faster moving, right? So that's where we have our indicators that will feed into our models every single day. And if anything from evaluations, economics, financial conditions, or sentiment point of view changes, if that gets reflected in the data, then we're happy to adjust our positioning. So that's, the take on the two parts.
Great, thanks, Shriya. Next question is, you mentioned for the Prescient Equity Fund, the beta is dynamic. How does this work, and has your positioning changed? I guess it's an equity one for you.
Yeah. As soon as you said Prescient Equity Fund, yeah. So it's quite right. So the Prescient Equity Fund, unlike the other funds, has a dynamic beta. So it's not a set index, which of course means we are solving for this exposure on a daily basis. And we can get some insights from it because it gives us a reliable estimate of basically the average equity allocations of the entire market. So I think the one thing to notice there is that, this process is quite smoothed, so it doesn't move around on a single day based on allocations. It's more over time, and so right now we're mainly seeing sort of like capped ALSI about 66%, and I think about ALSI 10%, and with a majority of that tail in small and mid caps. So yeah, we have seen a bit of a shift from sort of larger caps to more small caps, but again, this is a gradual shift in the equity allocation of the entire aggregate equity market.
Right, thanks, Seeiso. Next question is, if US drops interest rates further as expected and our MPC focuses on 3% inflation, would this not support the strengthening rand, albeit with little growth prospects? Your comments, please.
That's a macro one, that's yours.
I'll take that one. Yeah, so all else equal, I will agree with that. So definitely a tighter interest rate differential would mean, or especially a tighter real interest rate differential, so after inflation, would mean that the rand has room to strengthen, and there's nothing wrong with it. It's in fact one of the factors which we use. The reason why we're slightly pessimistic on the rand despite that is like one out of all the other circumstances which we are observing. A slowing US economy is generally bad for risky assets and for emerging market currencies. The fact that inflation in the States is not going to be a problem and going to continue to surprise on the downside, last print again surprised on the downside, that actually from a real interest rate point of view narrows the gap. So with that, argument in itself would be right that lower inflation in South Africa and quite hawkish SARB would be positive for the rand, but we do think that the global factors in this environment which we're in right now actually dominate. I hope that answered that one. There's another one again on equities, so that goes to you.
Okay.
Equity performance, you had good alpha and you had good beta. Are there concerns around the correlation between those two?
Oh, yeah. So, okay, understand. So, yes, year to date, obviously beta has been incredibly strong, like in the mid-30s. And coincidentally, our alpha has also been relatively strong, which has led to this great performance. And while it may seem that, okay, you've had good alpha and good beta, and therefore the two are correlated, actually, if you look at it over time, it's the exact opposite. There's sort of no correlation to slightly negative correlation, which is exactly what you want, right? You don't want your ability to outperform the market to be tied down to the direction of the market. If anything, you want it such that when the market goes down, the ability to outperform it actually gets more, which is exactly what you would see if you just look at our performance numbers, alpha versus beta, over the long term. This year, I take the point. Yes, we've had good alpha and good beta, so it seems like they're correlated, but through time, they actually is no correlation and slightly negative correlation.
Yeah, that's great. Thanks, Seeiso. If you had to invest and hold over the next 10 years, which of your funds would with high probability deliver on retaining global purchasing power as a SA investor? Okay, I will take that one. I was at the risk of giving financial advice, which we're not allowed to do, but obviously if you look into a balanced fund, our balanced fund maybe, it obviously carries a lot of offshore, 45% offshore, so that naturally has a natural hedge to global purchasing power. So there we should achieve CPI plus 6, that's what we're targeting, and that's even after costs. And then obviously also the large offshore portion. So two reasons to believe that will deliver on that. And then obviously all the equity funds, which Seeiso has been speaking about, they are designed to give you more than CPI plus 6 even. So that should then also retain purchasing power even if you want to be measured on a global space. So yeah, I think those would be the two. Next question is, are you seeing value in emerging market equities versus South African equities?
Okay, I'll take that one.
Yeah.
So it's quite interesting because when this webinar was recorded about a week ago, we were moderately negative on SA equities and we were neutral on emerging market equities. Now, when I looked at the views this morning, we've actually moved to moderately negative on emerging market equities. So we're quite negative on both at the moment. What actually moved that view from neutral into moderately negative was economic growth. So just like Bastian showed at the beginning of the webinar, we're able to measure the real-time growth of the US economy. We do the same for China. We do the same for South Africa. And what we've found is that in the China indicator, we've actually seen growth coming off, and that's actually moved the position from neutral overall into moderately negative. So in the South African space, I'd say it's driven a little bit more by sentiment being quite negative, as Seeiso alluded to. Whereas in the emerging market space, I'd argue it's a little bit more driven by valuations. So just to sum it up, across the board, valuations in both geographies are expensive. Economic growth in South Africa is pretty neutral, but in the emerging market space, it is coming off a little bit. And then financial conditions overall are tight and sentiment is also coming off. So markets complacent still.
Great. Thanks, Shriya. Next one is pretty similar, but slightly broader based. So it says, you mentioned that global markets are expensive, financial conditions are rather tight, and the economy globally is headed for a slowdown. In which asset classes do you position yourself for such an environment? So it would be exactly those which Shriya mentioned. So equities across the board, we would be slightly more conservative. That's DM equities, EM equities, SA equities, small caps, large caps, you name it. So tilt towards having less equity exposure. Same applies to the property sector. So we hold slightly less risky assets in general. If we look into the fixed income space, we're slightly more cautious at the back end of the South African government bond curve. So that's where naturally there's more risk. And then we're more optimistic on the front end. So the very conservative part of the SA curve, that's where we see those great real rates with very low inflation in South Africa and still like very high nominal rates, giving you great real rates with very little risk. So that's how we position ourselves. And then even haven assets. So if we look into the US yield curve, again, that's where we actually overweight the haven asset, the US yield curve, particularly at the front end where we would benefit from more interest rate cuts in the States. So it's reflected throughout. I can even take it maybe into the currency space, and that's the last one. We are, as mentioned earlier, more positive on the dollar than on the rand. Again, a haven currency which should benefit from this like uncertain outlook here and then basically create stability within your portfolio. Okay, last question which we're going to take because we're running out of time, although there's many, many more, which is really exciting. Does it not get expensive if you're constantly trading in and out of asset classes? How long on average do you hold a position?
Okay, I'll take that one. So it's not expensive for us to trade at all because we get our exposure through the use of our own funds or through the use of derivatives like futures, which are very efficient, very low cost, and we're able to get in and out of positions quite easily because there's always enough liquidity. Whereas if you're buying single stocks, it can be quite concentrated, and if you're holding quite large positions, then you're going to struggle to move. So that's not a concern for us. It's actually one of our big competitive advantages. We are able to move quickly at a low cost and get to our positioning very efficiently. And then how long do we hold a position for? So we're not high frequency traders. We're not high frequency traders, but we're not scared to trade either. So we'll only trade when the models say we must trade. So whenever it's warranted, we will do it. And so, yeah, we're really not tied to any holding period. It all just depends on what the indicators are doing. And looking at our strategic asset allocation, I mean, you could argue that we always hold a position, right? And then we move when our tactical asset allocation models move, which could be quite frequent. So hope that answers the question.
Yeah, so it's all about being nimble and efficient. I guess that sums it up. Thanks everyone for joining. We can't take any further questions from here, but we would be thankful if you could once again join for the next webinar. Thank you. Cheers.